Good morning, everyone, and welcome to the video conference for the results for the fourth quarter and for fiscal year 2023 Vivada. The company will make its initial comments and analysis of financial performance, and then we will go on for questions and answers. For those of you who need simultaneous translation, just click on the globe on the bottom of the screen and choose interpretation. You can listen to Portuguese or English. For those of you listening in English, you have the option to mute original audio. For those who are sell-side analysts, you are invited to take part in person. Just include your name and the company in the Q&A icon on the bottom of the platform, and we will let you talk. This will be, you will be invited to then use your audio and video turned on to ask your question. Just click on the button on the bottom of your screen. For other participants, please send your questions through the Q&A icon at the bottom of the screen. If your question is not responded during this video conference, investor relations team will contact you later to answer your questions. From Vivada, we have Mr. Otavio Lira, Financial Director, and Melina Rodriguez, Director of Investor Relations. Mr. Otavio Lira will now talk about Vivada's financial performance for the fourth quarter 2023 and fiscal year 2023. Good afternoon, everyone, and welcome once again for the fourth quarter and fiscal year 2023 results. Before we get going, and before we dive down into the details, and it's very important that we pay close attention, this week begs that we make some comments. There was a change in command at the company. We understand perfectly that changes can bring concerns, and people are always anxious and have lots of questions when things like this happen. You and the market, those of you listening to us today, are pushing for greater visibility and transparency. And that is why I have some important messages, some confirmations. I want to talk about some of the characteristics of our business that never change. What we have always shared with you in terms of corporate strategy throughout all of these years as a listed company. We continue with our primary channels and avenues for 2024. I will now focus on this short term, obviously, but we expect 70 to 80 new store openings this year. We are expecting a year of market growth, market share growth, corporate growth. Life continues to grow extensively, including greater revenue share and lots of growth moving forward. We have a lot of work to internationalize Life and the manufacturing plant. We went to a new plant last year, so we had to stop production at 2 different points and move the plant. So we had to push some of the sales to outside the company. And that reduced a little bit our internationalization focus. It's a huge mission that we have for this year to decrease imports and to increase profitability. And this is still on our radar, very much so. Even with tax challenges, our business model allows us to grow and to gain in terms of profitability. Our competitive advantages have not changed, and they won't change moving forward. and we will continue to capitalize on this both next year and for the years to come. We expect to generate a lot of operating cash in the next few years. We posted excellent results in this regard, and I'll talk about this a little bit later as we go deep down into the fourth quarter and the fiscal year. But in 2024, we always saw that this was going to be a, a turning point or an inflection point. Intense years of investment, years of new systems, digital stores, heavy investments in general. We see that the business is sustainable, strong bases, and this is going to sustain accelerated growth that we expect to see in the next few years. This cash generation is not just good for cash flow, but it was excellent in the final quarter, and it's going to be great for 2024, and it's going to allow for greater to take better advantage of our fiscal assets. We got a special tax regime for our tax credits in São Paulo with the ICMS taxes. And this was excellent for our retail business. This is significant. We're talking about 90 million reals when this new tax regime was passed. We've seen some material advantages already at the end of the year as a result of this. And this will continue to generate positive results in 2024. Not just to be able to take advantage of what we generated in credit in the past and what we're going to do in terms of tax credits, but this is also just going to be better for the fiscal regime when it comes to purchasing gold. The credit formation cycle will be reduced vis-a-vis what it was before, and this leads to improvements not just for the results in 2024, but profits and results in following years as well. Finally, I think it's important that we take a break here to talk about our push to internationalize. The company has always desired to expand abroad, to exploit this potential with a strong brand, with wonderful characteristics and traits from other businesses that were successful outside of Brazil. We're a high margin retail, which means that we can be a little bit more courageous and bold as we do this. And we're looking at the challenges, but we know that we know that we're facing challenges, but we can't not push forward and take advantage of this opportunity moving forward. We want to be able to sustain a growth cycle for longer and may have be stronger. And if we don't start now, we won't be able to do it in the time that we need. We won't be able to sustain the business in the timeline that we need because of this acceleration, this growth acceleration that all arrows point to. This is the right time. Our very first tests, our very first pilots into these foreign markets. We're gonna start with pilots this year. There's going to be no material change for capital allocation for the company, but this is the right moment. And now I'd like to talk about the quarter results. Once again, I'd like to invite all of you to really pay attention to these numbers. I think that's what we deserve. The situation is extremely interesting, and you can see a lot of these changes reflected in these results, as I already mentioned. I'll try to make quicker comments so that there's time for questions and answers. I'm sure you all have lots of questions, and Millian and I are here to answer every single one of them. So I'm not going to go through the entire presentation. I'm sure you've all seen it. I'm sure you've all reviewed it. For those of you who haven't, please review the results. You can really see, look through the release. You can see the trends, not just for the quarter, but for the year and moving forward. But I'm just going to go over the main highlights and make sure I touch upon them before we go into questions and answers. Let's look at 2023. Not the quarter. Let's look at 2023. I'm going to start with slide 4. Again, year 2023. This was the year of deliveries. Just like in years past, this is a year that merits celebration. We continued to implement systems and innovation throughout the company. Again, it was a year of major changes so that we could really sustain all of this growth. It was a year of stock adjustments, inventory turnover, and a year of resilience. And I will show you this throughout the presentation. But it's a year of records when we're celebrating these records. $1 billion in sales in just one quarter. Life as a records as products, and it still continues to grow and continues to grow because of the new store openings that we expect, but also because we saw excellent performance as well as excellent maturity in our portfolio of current stores. 71 store openings this year, record. We can see that we're continuing to expand as we communicated to you all, as we've already disclosed. And once again, solid deliveries in this regard. We were never as organized as last year in our deliveries. It's going to be yet another year of many, many store openings where we've got all our ducks in a row for the first time. We've seen these excellent opening numbers earlier than we expected, earlier in the year than even planned. So that reduced some of the risk in the second half of the year, especially in the last quarter. You don't want to be opening stores right at the end of the year, right? So you want everything ready to go. So all the stores are ready to go. They're open, excellent customer service. We're headed in the right direction to continue with this accelerated growth. Diving down again into the numbers. This was a year of strong growth, extraordinarily strong growth, and especially in retail. We expanded our share. We consolidated quickly and 2.2 additional market share, and it's going to continue significantly growing in the Brazilian jewelry market. We only see additional capitalization on top of these changes that we've already implemented. We've got a strong brand, an efficient industry with greater penetration than ever before, as well as well-executed retail, well-controlled retail. 2.8 billion in gross revenue, with 21.2% growth, Same-store sales, 12.4% versus 2022 because of Life and the opening of the stores and the more recent openings in just the last 24 months, but they're already part of the metrics here. But this is also because of Vivada's healthy growth in and of itself, especially in the fourth quarter. We saw this wonderful expansion of same-store sales just in the fourth quarter. So this is the big driver of these numbers. Wonderful strategies for product strategies. It's not just the quarter, it's the previous quarter's excellent execution which has led to these wonderful results. This growth is driven primarily by customers. We had 70% more active clients here in the company. And when we talk about new customers, 30.4% new customers. Over 70,000 new customers. And even more just in the last quarter of this year. This is the advantage that we have when we look at seasonality. We've established a scalability over decades. And we notice this in seasonality. That's where we have our largest investments, and we really stretch out. We really take advantage of this competitive advantage that we have already. And this is only going to be growing moving forward. And we did this in a year of change, and a year of turnover efficiency, cash generation. When we increased our EBITDA margin, a margin of 29% of adjusted EBITDA margin, 408, nearly 480 million, a 19.6% increase vis-a-vis 2024. Strong growth, strong heavy investments, significant development in the pillars that is going to sustain this growth moving forward, and nevertheless, significant resilience in company results. There was a significant reduction in inventory turnover, 26-day reduction. So, and we delivered on those expectations that we set. It was a historic year. We were able to deliver and better improve the deliveries over the last 5-6 years. I see that this year was actually no different from years prior. And in the third quarter, we saw excellent growth. We saw the company's excellent ability for cash generation in this company, which better allowed us to allocate capital for our business. Nevertheless, the fourth quarter does deserve that we take a real specific look at it. There were some characteristics and there's some impacts we've described in our last earnings calls. And it makes it very clear when we look at just this fourth quarter here at the end of the year. As I see it, this shows us our true operating performance and how we need to look at it, especially in this very importantly seasonal period after adjustments and accounting adjustments, and has been happening since second quarter last year. And it's still very important. You've seen the numbers for the fourth quarter. 24% growth in gross revenue compared to the fourth quarter 22. Greater profitability, increase in same-store sales. Black Friday was very important for us. This really brought in excellent sales for us. It was really a boon. As I see it, our operating data disclosures in January meant that the market had a lot of expectations vis-a-vis our results. They had a really high bar set, even more than we had set. And yet we still saw 15% same store sales, 70% gross margin, 22 new store opening in the fourth quarter alone, and in addition of 87.3 million in free cash generation. And if you look at the release, you can see even more details, information regarding all of these numbers here. I said I'm not going to go through all the results, but give me just 2 more minutes here to quickly talk about something very, very important. This is again year-long results, not just the quarter, but this is super important. This is slide 6, which has some of our KPIs and our financial highlights. Note the first 2 lines: gross revenue, net of returns. Note here has gross revenue has grown. There's a difference between gross and net. This is the lower presumed credit, and also some of the changes in the company. When we look at Manaus and e-commerce, that's 32 million for the year. And this is part of the deductions in 2022 to 2023. We're still feeling the effects this year. These 2 effects lead to a slight difference in growth rates and do affect the company's operating results and should be taken into account when we look at true operating performance. And you see a net margin pressure because of the characteristics already mentioned, because the tax rate was adjusted, as I mentioned before. I hope that best explains some of the most important things. And I'm now just going to open up now for question and answers. I'm sure you've all read everything you need to read, but I'd rather just answer the questions live. So we will now start with questions and answers. Please keep in mind, to ask a question, just use the Q&A option at the bottom of the screen. First question from Luis Guanais, sell-side BTG Pactual. If you'd like to use your camera and microphone, go ahead. Can you hear me? Can you hear me? Yes. Good morning, Otavio, Melina. 2 questions on my side. First, expenses. Could you just jump into that a little bit, give some more details? In the release, this did affect margins because there was accelerated store growth and openings. I'd like you to talk a lot about. So what do we expect for expenses, specifically for labor, moving forward in 2024? Second question, could you also talk a bit about the credit? What can we expect, the tax credit, what can we expect moving forward? I'll start. Melina, feel free to jump in. Part of the expenses pressure is because of some of the difficulties that I mentioned before. even when we account for those, there are some increased expenses due to sales expenses and labor, as you mentioned. Labor with sales is often due to reclassification because we reclassified some of these expenses. This happened in the second quarter, and we've been discussing this actually over the last few results. There's also a pressure from new stores. We have a bigger number this year. Also because of our omni-channel. It grew much faster than some of the other channels. And this brings a lot of penetration for us. There's also pressure in this fourth quarter, not in the rest of the year, because of the benefit adjustments. To address turnover, retail turnover, we made some major adjustments for benefits for sales. And we will see some compensation in this regard moving forward. There were some other effects as well. Expenses pressure, expenses on third parties, primarily as this greater push towards digitalizing, and technological improvements. We have links to all the stores, more velocity, more speed when they do checkout with, and there's obviously a consequence to this because it requires heavy investment. And also a little bit of store maintenance. So I think these were some of the main factors. And now what can we expect moving forward? Part of these expenses for sales, we're going to continue to see them as in the business as we expand. But the pace of expansion is going to continue throughout 2024. A lot of stores are still maturing, and we expect that to continue. Benefit adjustments that happened in November, and so this will be it. We'll see the effects of that this year, and we're normalizing some of the other impacts. Omni is huge. I doubt it's going to be as equivalent in 2024, and we'll be able to smooth out some of the other effects. Again, there's the maturity of certain stores as well. So in this new scale, and now that we better understand how life functions, we have a better understanding of stores. So we do expect pressures in 2024, but nothing too exaggerated. The presumed tax credit is very important, as it was in 2023. We've been able to allocate capital, including especially for finished products across the company, working capital in general. Life is still rather new. In a year that didn't have any, or that's not going to have any changes in the plant, we're going to be able to offset some of these. The meaning is that the plant, despite the fact that we're going to move abroad with life products, relatively speaking, we're still getting non-favorable presumed tax credits vis-a-vis 2023. Now, that doesn't mean that it's going to be of a of a great magnitude. And we had some excellent profitability. And a wonderful opportunity is also to review price. And then now that we have one factory, not two, things should be a little bit easier. Gross margin, for example, we expect more gains moving forward, specifically in 24. But we do expect that this presumed tax credit may affect profitability moving forward. Thank you very much, Otavio. Thank you. Next question from Victor Rogatis, sell-side analyst, Itaú BBA. Please turn on your mic and camera. Okay, Victor. Thank you. I want to talk about gross margin. You just talked about the presumed tax credit. What about an increase in deductions with the ICMS tax in a lot of states throughout Brazil and the PIS/COFINS tax? That's my first question. If you could talk a little bit more about this tax. And then working capital, you said that it's going to affect stock, but not just in stock or inventories, but how should suppliers perform or what should suppliers be doing? How can you just talk about both those subjects? Thank you very much. The first point, in 2024, we do expect a slight gap and there's still going to be some pressure on certain line items. We're going to continue to see this pressure. This is due again to that presumed tax credit. In terms of expenses, we know for sale, this is going to affect gross revenue, not net revenue. But you know this already. This is nothing new. This pressure, we will still see it. But in 23, we looked at our fixed expenses and labor and looked for savings across the board. So the idea, as I mentioned early on, is that despite these increases and these adjustments and these state tax adjustments, we can use this to our advantage. And we still expect a year of expansion, market consolidation, where we still be able to preserve our operating results and our margins, regardless of some of these tax changes. That's our objective for 2024. Our business model allows us not just to deliver on profitability despite these challenges. What we have to ensure this profitability, unlike other sectors, is not just repass, but is the internationalization of life. And I think that few other companies have this to their advantage. So whether it's a credit, or ICMS taxes, or whatever it is, we still expect a year where we expect growth, operating growth, because of how we've positioned ourselves. And you asked something about working capital, right? I think we have a few advantages right now. When it comes to inventory, number one, expansion. Life is lighter when it comes to this regard. Most of the 80 stores that we opened this year are life. I think 80% are life stores. So naturally, over the last 2 years, that life's been part of our business. This is going to lead to greater turnover and greater efficiency. So we're going to see a reduction of cycle, which we expect moving forward. And this is going to be positive for all of our metrics. Occasional coverage reduction in gold jewelry. We believe in our potential to reach the same efficiency metrics that we in 2024 that we showed for 2023. We're not reducing coverage linearly. I think it was quite clear that over the year that we saw different cycles of investment in inventory over the years in the company. And we saw a very positive effect of this investment in Vivara. This investment for Vivara was excellent. It was very concentrated in gold inventory. We took advantage of this opportunity, a time where gold has doubled in value since 2019. And so now we're able to see a significant advance. Yeah, we were a bit more cautious back in 2019, 2020. So we're looking at all the bets that we've placed over the last few years and advantages that opportunities that we've taken advantage. Obviously, not all of the bets were the right bets. Sometimes raw materials are an issue, fleets are an issue. Since the beginning of last year, we started to focus on this and reorganize so that we could be more efficient in our jewelry inventory. We see some benefits there. We do expect some benefits in that regard this year. And suppliers are here to help us with this inventory reduction, because this actually leads to a reduction of some of our agreed suppliers. We have longer terms with them. Sometimes it's 90 days, 120 days. So as we reduce allocation of capital in raw materials, because of the inventory projections we have moving forward, this will affect our suppliers. So this is an effect that is completely correlated effect. Good point, Melina. Over 2023, where we saw there was a slight reduction in this line, we concentrated on raw material in the second half of the year, just before that Manaus shift. And then in December, we changed the gold line to the other factory. So purchases in the third quarter were even less than normal. So again, a lot of these agreements were even less important, as Melina mentioned. These agreement suppliers or third-party suppliers. Next question from Eric Wong. Sell-side analyst, Santander. Please turn on your camera and your mic. Can you hear me now? Great. Thank you. Thank you for the opportunity to ask a question. Gross margin. What about this curve for internationalization of life in 2024? What are the challenges? What should we be looking at as this plays out? And second question, looking at expansion, you mentioned this earlier. You expect expansion to be better distributed over the course of the year. I think it was in the release when you saw the number of openings. I don't remember how many store openings it was, but anyway. But I want to understand what you mean by being more distributed. What do we expect in this regard? And you saw the weight of some of these expenses. And we saw a little bit of an impact in the fourth quarter because of labor expenses. Is this going to be better distributed throughout the year? So when we look at this evolution of the margin, should it be a little more gradual? Like, how does it all fit together over 2024? I'm going to talk about the internationalization. Late 2023, 40% internalization of life, about 40% came from our factory due to the transition. We expect this year, and to deal with these tax impacts that we mentioned before, we expect to go up higher than 50-ish%, which is what we saw before. This effect, when we look at timeline over the year, production is generally linear. We have specific amounts that we produce generally each month, but the effect in sales is it depends on seasonality. And this obviously this affects the 2 quarters with the greatest seasonality, second and fourth quarter. But we look at volume produced every year. We have our own timeline here, lead time for production. We know what's going on every single day. We're looking at this every single day to identify how this production and the product is going to be delivered and what are the effects, delivery of new products, internalization of products. What we expect, we've got early in the year, then we've got Black Friday later in the year. We see greater margin in these 2 particular periods. Expansion. Otavio, you want to talk about expansion? Okay. When we look at expansion, we had a lot more in the first half of the year. Again, we should this year see 40 to 45% new store openings in the first half of the year and about 55-ish, 60% in the second half of the year. It takes about 120 to 130 days to get a store up and running. So it's natural that this takes a little bit longer, but we have a lot of contracts ready to go, signed. 80% of them have already been signed, and we've got this all set up on the timeline. 40%, 45% of these openings should be in the first half of the year. I think the good news is that, again, we've got these disclosures every month. We disclose these numbers every single month. So, you followed the first 2 months. You already understand, we've already 2, 3 months in. So you already know what's going to be happening with this quarter. You're already familiar with what's going on. The team is did a very good job when they mapped out these contracts and they mapped out opportunities as well. And they did an excellent job in that regard. So we're ready to get everything up and ready and ready for the seasonality that Medina mentioned. You ask for trends in terms of expenses and trend and these pressures in this first quarter of the year. We are still seeing the effects of the tax reclassifications and the line items reclassifications. Sadly, I have to say this again, but we have the same base starting with the second quarter. So it's going to be a lot easier. It's going to make it much more visible, much easier to understand. In the first quarter, the reclassifications affected the margin, millions of reals. So we need to look at this separately. And we're going to continue disclosing this information so that you can understand the impact, the true impact. The same thing is also going to happen with expenses. So I don't go on for too long. Please pay attention to the first quarter because it's going to require a more detailed review. Because of the readjustments, operating readjustments this past year. But again, we're looking to show better or ensure better understanding and comprehension of our results. We want to be more consistent when we explain our results. So following the second quarter of the year, as of the second quarter of the year, it should be a lot clearer. Thank you so much, Otavio and Medina, for answering my questions. It was very clear. Next question from Vinicius Strano, sell-side analyst, UBS. Please turn on your mic and camera. Good morning, Otavio and Melina. Thank you for the question. For marketing expenses here, would you please give us some more details? Where will your marketing expenses will be? And expenses in general, could you just talk a little bit more about them? Are there any other sources for more efficiencies to compensate for these larger or labor expenses that you mentioned because of some of the adjustments that you mentioned earlier? And in terms of light, if you could talk a little bit about the performance of Life stores in shopping malls where there's no Vivara stores. And also a little bit about tax benefits. How can we exploit this? How can this be positive um, for us in terms of taxes? Marketing expenses is one of the expenses that we pilot more. Moving forward, we don't expect this to change significantly as a percentage of our gross revenue. There's obviously a little bit more marketing or less marketing depending on seasonality, and it'll affect results. But it generally goes according to seasonality. Where we see leverage to decrease some of our expenses in administrative. There was some, because of the expansion, there was a lot of expenses, operating expenses. We had to mature some of the stores, but we do expect to see a reduction, a greater reduction in the short term. That's where we see a bit of a leverage for operating. Life, versus life where we don't have Vivada. We have 7 stores where that's the case. These type of stores are great opportunities. These contracts include some extra special benefits with the shopping malls. Sometimes we get extra time with lower costs, etc., lower rents, and it's really positive. So this is excellent. It's even better than what we had projected for these particular stores. They mature faster, a little bit slower, because life tends to because they depend on Vivada, but they're very profitable. They're maturing as expected, and there is significant return on investment vis-a-vis what we expect from the shopping malls. A lot of them have excellent results. For 24, we have a few more stores that we expect to fit this category, which is life stores where we don't have Vivada stores. And again, it tends to be places where we do have slightly slower revenue. What was your last question? Exploitation income. The factory explains us revenue vis-a-vis income. All of the effects that we've seen can be explained by lower production, and that means lower exploitation. Because it depends on our factory. So when we change the results, things are affected. You change, you have a different tax effects on the subsidiary versus the main store. So this is obviously going to affect the main company. So this is going to affect us. So in 2023, this is because of lower production in Conip and less effect of Conip throughout the year. But now for 2024, we're going to still normalize this effective rate. It's not the effective rate, normal effective rate for the company. There's a tend for this to be the cash rate. And this is going to play out throughout the year. And this is going to expect operations throughout the year, results from operations throughout the year. But that's what we said. I hope I answered your question. Thank you, Otavio. Thank you, Melina. Thank you, Vinicius. Next question. Question and answers period is now drawing to a close. The remaining questions will be answered by Investor Relations team from Vivada. Thank you very much and have a wonderful day. Thank you, everybody, and have a wonderful day. We're here to answer any questions you may have.